Welcome to today's Explainer. If you've been watching the markets lately, you've probably noticed that valuing a company is pretty often treated like a spectator sport. The average retail investor usually just sits back, hits refresh on their brokerage app, buys a stock, and then basically crosses their fingers, hoping the market eventually agrees with their spreadsheet. But today, we are going to undergo a fundamental psychological shift. We're moving away from being passive stock pickers. Instead, we're going to become aggressive corporate strategists. We are going to step directly into the shoes of the people who actually dictate a company's destiny. We're going to look at the market through the eyes of a corporate manager and an activist investor.
So if you really want to think like an activist, you have to completely abandon what Wall Street likes to call the bigger fool theory. Oscar Wilde actually hit the nail on the head here when he said, "A cynic is one who knows the price of everything, but the value of nothing." In the investment world, a surprising number of people will genuinely argue that the intrinsic value of an asset is, well, totally irrelevant, just as long as there's a bigger fool around who's willing to buy it from them at a higher price later. But activists and managers, they do not care if a stock is trending on social media. They don't care about momentum. They care exclusively about the raw, underlying machinery of the business. Because sure, chasing momentum might give you a quick pop of short-term profit, but there's absolutely no guarantee that this magical bigger fool is going to be there when you're ready to sell.
And that brings us to a really fundamental truth. Valuation is not about aesthetics, emotional reasoning, or shifting market vibes. It is strictly about the cash flow reality backing it all up. When you buy a financial asset, you are buying it for the actual, literal dollars it is expected to generate over its lifetime. A sound investor never pays more for an asset than it's worth, and that worth is tied directly to those cash flows. Look at it this way. Price is just what the market is asking on a random Tuesday. Value is the mathematical reality of the business.
Let's dive right into Section 1, the activist investor's lens, flipping the script.
Okay, here is where the big psychological shift really happens. A passive fundamental analyst basically looks at a company through binoculars, right? They look for a gap between price and true value, buy the stock, and then just sit on their hands waiting for the market to figure it out. But a franchise buyer, like a really aggressive activist hedge fund, they operate entirely differently. You see, you aren't just buying the stock and waiting. You are grabbing the steering wheel. You're acquiring the business because you believe you have the influence to force a change. Whether that means quietly buying up a huge chunk of shares, fighting for seats on the board of directors, or even publicly threatening a proxy war, you are buying control to actively unlock that hidden value yourself.
Moving right along to Section 2, the math of control. To really grasp how these franchise buyers operate, I want you to imagine you're an activist investor. You are absolutely not looking for a great company. Actually, scratch that. You are actively hunting for a total disaster. You want a company with great bones, but absolutely terrible leadership. So where exactly is your opportunity? If the current management is literally destroying value every single day, how do you mathematically quantify the upside of firing them and forcing them to change their ways?
Well, to value that kind of control, you have to estimate two very distinct numbers. First is the status quo value. That's what the company is worth right now as it's being run by the current underperforming management. Second is the optimal value, which is what the company would be worth if it were restructured and run perfectly. The gap between those two numbers, that's your potential upside. But here is the absolutely critical part. You have to multiply that gap by the probability of actually making that change happen. Let's say you buy 10% of a terribly run company, but the current CEO owns 51% of the voting shares and literally cannot be fired. Your probability of change is zero, which means your control premium is zero. This math dictates exactly what premium you should be willing to pay for voting shares.
Think about it. If a factory is already turning out gold at maximum efficiency, pushing the CEO out does absolutely nothing for you. There's no hidden value left to squeeze out. You want the leaky, broken factory, where you can just step in, plug the holes, and immediately start generating cash. The value of control is highest in poorly managed firms operating way, way below their potential. If a company is bloated, just sitting on piles of unneeded cash and throwing money at terrible projects, the control premium is massive. And that is exactly where the activist strikes.
Which brings us to Section 3, the activist playbook, bridging the gap.
Now, keep your activist investor shoes on for a second. What do you literally do on day one when you take over? Well, first, investment policy. You march into the boardroom and you kill the old CEO's pet projects that are just bleeding cash. You ruthlessly sell off unproductive assets and reallocate that money to earn higher returns. Second, financing policy. You look at their lazy, all-equity balance sheet and you introduce strategic debt to lower the overall cost of capital. And third, dividend policy.
If the firm really has no good investment opportunities left, you stop them from hoarding cash just to build vanity empires. You force them to return that unneeded cash straight back to the shareholders as dividends or buybacks.
All right, let's flip the script in Section 4, the manager's value blueprint.
Okay, now you are the CEO. You're the one who has to execute changes while constantly fending off those very activists we were just talking about. And let me tell you, this is an immense psychological burden, especially if you're running a young, high-growth startup. Because the bulk of a young firm's value comes from its future growth potential rather than its current assets, they're incredibly vulnerable to the crushing weight of market expectations. As a manager, you have to find out exactly what investors expect of you, and not just next quarter's earnings, but what they think your core competitive advantage is. You have to actively talk down those expectations if they get irrationally high. And crucially, if the underlying economics of your business change, never, ever delay the inevitable. Trying to hide bad news with clever accounting only ensures a way more brutal punishment from the market when the truth finally comes out.
And that leads us straight into Section 5, pulling the value levers. As a manager, you really only have 4 true ways to structurally create lasting value for your firm. That's it. Just 4 levers you can pull. First, you can increase cash flows from existing assets by cutting costs and driving operational efficiency. Second, you can increase the expected growth rate by aggressively reinvesting in high-return projects. Third, you can stretch out the length of your high-growth period by building formidable moats. We're talking about securing patents, cultivating fierce brand loyalty, or establishing massive barriers to entry so competitors can't touch you. And finally, you can reduce your cost of capital by optimizing your debt ratio. Seriously, if an action doesn't touch one of these 4 things, it does not fundamentally create value.
And this brings us to a pretty harsh reality check for corporate leaders. There is a massive difference between doing the actual hard work of value creation versus just distracting the market with cosmetic, value-neutral illusions. So why do managers so often fall into the trap of cosmetic changes? Well, because pulling those 4 real value levers is painful. Closing an underperforming plant means firing people and facing terrible PR. Taking on strategic debt is risky. But executing a stock split to make your share price look a little more accessible, or changing your inventory accounting method to smooth out reported earnings, that takes 5 minutes and it offends nobody. Yet neither of those accounting tricks changes your actual cash flows or growth rate. True value enhancement is hard, grueling work.
So, to wrap up this explainer, remember, valuation isn't a spectator sport. It is a blueprint you can use to actively shape reality. Whether you're an activist investor hunting for a control premium in a leaky factory, or a corporate manager doing the incredibly hard work of optimizing cash flows to keep those exact activists at bay, the math is exactly the same. You have the tools right now to uncover the gap between the status quo and the optimal. So I'll leave you with this. If you were handed the keys to your absolute favorite underperforming company today, what is the very first value lever you would pull to change its destiny? Think about it. Thanks for joining me on today's explainer, and keep looking for that hidden value.